Welcome and thank you for joining us today. We're happy to have Shirley White Stevens here to talk about saving for college. If you have questions, please post them in the chat and we'll get to them at the end of the presentation. So let me start by introducing Shirley. She is a certified financial planner and a certified college planning specialist. As a college planner, her goal is to help families who do not qualify for need-based financial aid to reduce the overall costs of private school and college, and to ultimately be able to save more money for retirement. She has authored numerous articles on education funding and serves as a registered advisor for the NICCP and savingforcollege.com. She holds degrees from Ursinus College and has done graduate work at Temple Medical School and the University of North Texas. So Shirley, welcome. I am going to turn it off to you. I'll turn off my camera and I'll share your presentation.
Thank you. Welcome, everybody, and we'll get started with this. We're going to talk about all the different ways, or most of the different ways, you can save for college. And the best way is not the same for everybody. So you have to pick which one fits your particular situation the best. There are some that have more advantages than others, which we'll talk about as we go through. So let's get started. College savings are, we've a recent college savings survey said 68% of respondents had already started saving for college using a variety of different types of accounts. And 44% of respondents who aren't saving say they haven't started because they don't have time to research their options. Well, hopefully today's presentation will help begin that research for those of you who are in that situation. If you're still undecided about the best way to save for college, this presentation provides information about 6 common accounts that you can use and the biggest pros and cons of each. So regardless of how you choose to save for college, one of the best things you can do is to save early and save often. Whatever you can put aside today will lower your child's student debt burden in the future. All right, let's change to the next slide, please. Our first type of investment we'll look at is mutual funds. Mutual funds are diversified investments managed by a financial professional or an investment specialist. And they're popular for retirement plans and other types of plans. And it gives you the opportunity to invest your money in several different securities, including stocks and bonds, ETFs, closed-end funds, mutual funds, all kinds of things. Earnings depend on mutual fund performance and may come from capital gains, dividends, and bond coupon payments. Let's look at the pros for investing with mutual funds. You can spend the funds to save in a mutual fund for anything. So if you don't use it for college, you can use it for buying a car, going airline tickets, computers, etc. And there's no limit as to how much you can invest. There are more than 10,000 mutual funds available and a very wide variety of investment options. So you can definitely invest in most anything and for any amount of money. Some of the disadvantages of investing in mutual funds. Mutual fund earnings are subject to annual income taxes. And if you're depending on what tax bracket you're in, that might mean a lot to you. And any capital gains are taxed when shares are sold. So mutual fund assets owned by a parent will impact financial aid ability. So you don't want to have a parent owning mutual funds if you think you can qualify for financial aid through the school. The FAFSA, which stands for future, sorry, my throat's giving me some problems here. that's what you fill out online to get through to whether or not you can qualify for financial aid. They consider money transfer from mutual funds to pay for college as income. And the higher your income on the FAFSA, the less chance you have of getting financial aid as far as need-based aid. Now, there are lots of other kinds of aid that you can apply for also, which we'll talk about as we go through this presentation. So let's change slides. Another type of investment is custodial accounts, and they're known as uniform transfer or uniform gifts to minors accounts. These custodial accounts are opened by an adult on a child's behalf, and the funds are diversely invested, either in stocks, bonds, mutual funds, etc. Again, quite a good range of things that you can invest in for custodial accounts, just about the same as in the mutual fund accounts. These accounts are usually held by a parent and then transferred to the child once they turn 18 in Texas. Some states require 21 or 25 as being the age to transfer. Let's look at the advantages of investing in custodial accounts. You can spend the money saved in a custodial account on anything, whether it be cars, free of qualifying additional expenses, making the best way of saving kids for some people. There's quite a range of things that you can do. There's no limit to how much you can invest. There's a value, the value of the account is removed from the donor's gross estate, which is sometimes helpful depending on who the donor is and what their estate situation is. The value of the account is removed from the donor's gross estate. We just managed to get that put on there twice somehow. Should only be on there once. Let's look at the cons of investing with custodial accounts. Earning and gains are taxed to the minor and subject to the kiddie tax. So where unearned income over $2,300 for certain children through age 23 is taxed at the marginal rate applicable to trusts and estates in 2022. So it's not always the right thing to be doing, depending on your situation with your students' income, etc. Another disadvantage is the student will gain rights to the account once he is or she has reached legal age. So when they turn 18, they can use that money for anything they want to use it for. They don't have to use it for college, even though maybe that was what the original intention of the parent was. And maybe you don't want them to use it for anything but college, but you don't have any control over it after they become 18 and take charge of their own account. Custodial accounts are counted as student assets on the FAFSA, which count more heavily than the parents' assets on the FAFSA. So that means that it reduces student aid by quite a bunch, and can reduce the student's aid package by 20% of the account value. So those are all things to consider when considering an UTMA account. Let's change slides again. Okay, qualified U.S. savings bonds. We have quite a, sorry, I've lost my spot here. Okay. For savings bonds, there are two types of Series E, and I bonds that if you purchase them after 1989 can be redeemed federally tax-free to qualify for higher education expenses. So for some people, this is a very good way to save for college. And then bond owners are invested in interest earning bonds backed by the full faith of the US government. So they're not going to lose value. Like if you have your money in the stock market and we have a crash, and just about the time you have to take money out, then you can lose that way. But with bonds, you can't, because they're guaranteed to pay you whatever you signed up for in the beginning. Now, that might not be terribly high as far as gains are concerned, but still safe. Some of the disadvantages of investing in bonds: the maximum investment allowed is $10,000 or $20,000 for a married couple per year. So if you're planning on saving more than that per year, this might not be your choice. Also, interest exclusion phases out for incomes between $128,650 and $158,650 for married couples. So if you earn over that $128,650, you won't be able to exclude as much as you thought maybe you could. And for married couples filing jointly, or for individuals, $100,800 is the cap on that. If bond proceeds are not spent for tuition or fees, interest earned will be included in federal income and subject to tax. So where other investments you might be able to use for other college expenses other than just tuition and fees, not so with the bonds to be able to include the federal income that's subject to tax. Okay, let's move on. Roth IRAs. Roth IRAs can be a very good investment for college. There are cons to that too, but there are a lot of pros that are good. A Roth IRA retirement account lets you contribute after-tax income to earn interest tax-free. You can withdraw the funds once you turn 59 and tax-free without penalty. Normally in a Roth. However, if you're taking it out for college, it's considered untaxed income to the beneficiary, and there's no tax on it as long as you've had the Roth account open for 5 years or more. So pros for the Roth IRA: contributions can be withdrawn at any time for any reason. However, if you withdraw them at the wrong time, you could be charged a 10% penalty plus tax on it. So you have to look at that and what is the right time that you can withdraw for any reason. Obviously, after you turn 59, you can withdraw without penalty. The normal 10% early withdrawal penalty on earnings is waived when the funds are spent for qualified higher education expenses. We've already mentioned this. The normal withdrawal, you don't have any withdrawal or taxes as long as it's spent on qualified higher education expenses. And there's a broad range of investment options available. Again, you can invest in just about anything from stocks, bonds, mutual funds, closed-end funds. It's wide open for what you put in your Roth IRA. And then the value of retirement accounts is not counted as an asset when you fill out the free application for federal student aid, which is the FAFSA. You can not have to report any of those retirement things when you fill out that form. So therefore, they don't know that you have that extra money saved until you start cashing it in. Some of the things that you might not like about investing in a Roth IRA: the maximum investment allowed is $6,000 if you're under age 50. And if you're over age 50, you can invest $7,000 a year, but no more. So only married couples earning less than $214,000 in 2022, or individuals earning less than $144,000 can contribute to the maximum amount. So if you earn over $214,000 as a couple, you can't contribute. to the Roth. So that might not be the account for you. Married couples earning $214,000 or more are eligible to contribute, or $144,000 for individuals. Withdrawals from a Roth IRA to pay for college are considered base year income for the FAFSA. So once you withdraw money from your Roth IRA, the next year you have to report that as base income when you fill out the federal student aid form. So that's something to consider. Okay, changing slides. Slide 5 got labeled wrong. This should say Coverdell Education Savings Account, ESA, Coverdell ESA, previously known as the Education IRA. The Coverdell Savings Account is similar to the 529 plan in that they permit tax-free interest earnings and withdrawals for qualified educational expenses. Unfortunately, they're not available to every family and have lower maximum contributions than other college funds for kids. So the pros for investing in college Coverdell education savings accounts. You can take advantage of tax-free withdrawals to pay for qualified higher education expenses, but you can also use them for K through 12 expenses up to $10,000 per year. So if you have a child that's taking special courses to maybe prepare for college or something, or needs special equipment in high school, they can withdraw from the Coverdell savings accounts for those expenses. Over the life of the account, the deposits up to $16,000 per year per individual will qualify for annual gift tax exclusion. So if you need that on your taxes, that might be a good thing to consider on the Coverdell. There's also an option to treat a contribution up to $80,000 in 1 year as if it were made in 5 years to shelter a larger amount from taxes. So if you want to spend $80,000 in the freshman year and then spread it out for 5 years on your taxes, you can do that. And you don't have to be worried about deposits of lesser amount being able to be taxed or considered for tax reasons. Coverdell education savings bonds also value. It can be considered no matter what, whether it's parent or independent student owned, it can still be used the same way. Cons, things that you don't want to get into trouble for, is the maximum investment allowed is $2,000 per beneficiary per year, combined from all sources. Okay, and then contributions have to be made before the beneficiary turns 18. After they turn 18, you can't contribute to this fund any longer. And the account can only be used until they are 30 years old, and then it can't be used anymore. So there's a time limit on both ends. Only married couples earning less than $220,000 or individuals earning between less than $110,000 can contribute to these funds. So let's change slides one more time. 529 plans. Okay, withdrawals spent on qualified higher educational expenses and up to $10,000 per year in K through 12 tuition avoid federal income and capital gains tax. And if you're in a state or the child's in a state where there are state taxes, we don't have that in Texas, thank you. But if you are in a state there are state tax benefits available also from 529 plans. And 529 plans can be considered as favorable financial treatment for dependent students are treated as parents' assets and nothing has to be reported on the FAFSA. Seeing as that dependent students, if they report it as an account owned by their parents, as a parent asset, it counts less against them when they complete that FAFSA form and withdraw for college. So that's a good thing. Depending on which plan you use, maximum investments can exceed $500,000 over the life of the account, and deposits up to $16,000 per year per individual will qualify for annual gift tax exclusion. So we're looking at this $80,000, contribute up to $80,000 in 1 year and then spread that over 5 years so you can shelter a larger amount for taxes rather than just your $16,000 per year. 529 plans receive favorable financial aid treatment. Accounts owned by dependent students are treated as assets for the parent and have to be reported on the FAFSA when the funds are withdrawn to pay for college. Well, sometimes grandparents buy into 529 plans, and we'll talk about some of those when we look at the next slide, please. One of the cons for investing in 529 plans is earnings are subject to income tax and a 10% penalty if they're drawn for anything else other than qualified education expenses. So you don't want to save more than what you're going to spend for college, or if you have more than one child, you can transfer that 529 plan for the first child that doesn't use it onto the second one or to another beneficiary. But if you don't do that, you have a 10% penalty on the withdrawals. And investment strategies available are limited. That's because the 529 plans have their own set of investments set up. And although there are several that you can choose from, you can't choose on the individual accounts under each one. So you're subject to whatever that 529 plan is investing in. Withdrawals from accounts owned by someone other than a student or their parent have to be added back to the student's income in the following year's FAFSA. So if a grandparent buys into it and gets a 529 plan for their child and it's in the grandparent's name, well, when they take money out in the first few years of college, that gets added back into the student's income that they have to report on the FAFSA for the next year. So that can reduce quite a bit on the eligibility for financial aid, especially need-based financial aid. There are ways around that. If you have enough that you don't have too much in there that you can't wait until you file your last FAFSA, which is in your junior year, you can use that money and it won't be seen on the child's report on their income because they won't have to report it after that. So that's one way to use grandparent funds. Wait until the end of school and the last 3 semesters you can use it for and not be seen for the FAFSA. All right, let's change one more time. So how do you decide which plan to choose? With so many savings options, what's the best right account for you or your child or grandchild's college education? Here are some questions to ask and corresponding plans that might be a good fit. All right, let's look at which ways that might work. Let's change slides one more time. All right, here's some questions to ask yourself when you're trying to figure out what plan to use. Do you plan to use the funds only for college expenses? Well, if you do, then 529 plans offer the most tax benefits for your funds. However, you'll face penalties if you use the funds for anything else. So If you're not going to use it for anything except college expenses, it might be a pretty good deal. Then you might ask yourself, do you prefer to use the funds for other expenses? Well, if you anticipate that need for expenses like a car or rent or custodial accounts, and mutual funds allow you the flexibility to do so without incurring penalties, the 529 plan would not do that. So it might be that you would want one of the other types of plans if you're going to do that. Think about it that way. Another question to ask yourself: do you plan to fund more of your college education with federal financial aid? Well, if you're depending on financial aid, you need to be cautious about which accounts you make withdrawals from. Any consideration of income for the college student can disqualify them from certain financial aid. Now, we're talking about need-based financial aid here. There are lots of other types of financial aid which you can apply for merit-based aid, or for people in the college who might want you for their particular activities. Like you can sometimes get financial aid when the director of the band or the orchestra wants your instrument to play for them. So they'll go to financial aid and ask, okay, what do we do to get this child some money so that they'll come here to college and play in my band? Or maybe you have a theater student that the theater's department wants, or an athlete or a swimmer or somebody that to be on your teams. So there are lots of different ways to apply for financial aid other than just the need-based aid. There's the merit-based section too. So don't forget to consider that part. All right, next slide. Okay, tips to complement your college savings. And we'll move on right here. So have you set up a couple of educational savings accounts, but still want to learn more about how you can maximize savings? Here are some tips. Apply for scholarships. Okay, next slide. We can apply for scholarships, which we've already talked about. Don't let that deter you from applying for lower value scholarships. Those can add up too. But if you think you qualify for a full ride scholarship, you might want to consider that before you consider anything else and how else you're going to save for college. Another way to pay for college is to work during the summer. Of course, you can work during school too, and sometimes you can get a job on campus, like I myself waited on tables in the dining hall, and when I was going to school, and also was a tour guide through the school. There are many types of work you can do that way through the school, which aren't too taxing. But if you're taking on a regular job, you probably want to try and limit it to summertime so that you can focus on your studies throughout the school year. Another way to save would be to get AP credits. If you have in high school, your high school offers AP credits. You can save the cost of credits for college by getting those credits ahead in high school, and that's less that you have to pay for when you get ready to go to college. All right, next slide, please. It's never too late to start saving for college, and it's never too early to start saving for college, because any amount you can save will certainly help you get ahead on your college savings. So you have a newborn, you want to start saving? Great, start right away. If you haven't saved and your child's in high school, but you want to start putting some money aside, you can do that too, if you're in the right type of account. So now I guess I'm open for questions. Anybody have any questions?
All right, so if you have questions.
They've left for us.
We don't have any yet, but if you have questions, you can post them in the chat, and then we'll answer them. And while I'm giving you a minute to do that, I'm going to give you Shirley's contact information in the chat as well.
You could feel free to contact me with questions that you have that maybe it's lit up in your mind as we went through the slides. And if you come up with questions later, feel free to contact me, send me an email, and I'll do my best.
Email, and I will also send a copy of the slides to everyone who attended via email later on today. And then I'll also include this contact information. So we'll give it another minute, but it looks like we might not have any questions. All right, well, thank you guys for joining us today. I hope you gathered some good information. And as I said, we'll send out the slides and Shirley's contact information in an email later today. We will be hosting a series of financial planning lunch and learns throughout the rest of the year. Our next one will be on August 17th, and we're going to talk about saving for a home. So please visit our website to register. And in case you want to review or share the information in today's presentation, we did record it and we'll post it on our YouTube page in the next week or so. We'd love for you to subscribe to our channel and turn on those notifications to get more presentations. So thank you very much, Shirley. We really appreciate you being with us today. And y'all guys have a nice afternoon.